Hey guys, my name's Jose, and this is another episode of Buy or Pass. In this series, I will look at the financial documents of a company and decide if I was looking for another investment, would I buy or would I pass? Before we start, don't forget to hit that subscribe button to get info on new episodes and other videos. So let's begin. Like always, I'm going to use the website known as lazyfa.com, which helps me view all these financial numbers in an easy visual format. Today, we'll take a look at Coca-Cola. In Coca-Cola, we're going to do what we normally do. We're going to take a look at the income statement, the balance sheet, cash flow statement, and some other metrics. At the end, we're also going to take a quick look at their 10K report just to see if we see any unusual behavior in that report. So here we're on the income statement. In the income statement, since they just reported Q4, again, I'm going to take a look at annual data instead of quarterly data. So let's begin. Here revenue, we can see revenue has been decreasing since its high in 2012. Each year has been lower. This year is sitting at $31.8 billion of revenue compared to last year's $35 billion of revenue. Cost of revenue, the same. We should expect this to go down, right? If they're selling less stuff, we would expect them to be spending less money to spend this stuff, which is what we do see. Cost of revenue this year was $11.7 billion, where last year was $13.26 billion. Gross profit is also decreasing, which is obviously the difference between revenue and cost of revenue. We have a negative gross profit of $20.09 billion compared to last year's $22.16 billion, almost a decrease of about 10% in gross profit. Somehow this is pretty great to see. Earnings before income taxes. So here we can see their earnings before income tax is higher than last year's, even though revenue is lower this year, and it is on par with last. It's higher than also 2 years ago, which again revenue was much higher there. So this is telling me good stuff, right? It's telling me that this company is able to be efficient with its money, and it's, even though it's collecting less revenue, it's still able to have the same amount of earnings before income taxes after all its expenses and after a decrease in revenue. So once this company starts collecting higher revenues, this company will actually be looking really good for earnings before income taxes. So that's definitely a plus in my books right now. I was kind of a little I was thrown off with such a huge revenue drop, but seeing this net income, this income before income taxes, is definitely a good thing to see. Now here we can see this net income. Here last year, it seems they probably paid a huge expense on tax, and we can probably take a look here. Yeah, last year they paid a huge tax expense, which made this company have a very low net income last year. But if we take a look at net income this year, 6.43 billion compared to 2 years ago, which had about the same tax expense, was 6.53. So again, revenue has dropped from last year by over $10 billion. So revenue dropped down in 2 years by $10 billion. This to me was pretty scary. But we're seeing this net income only drop down by $0.1 billion. So that's a huge offset, right? I would have expected the net income to drop so much more, but it did not. And that to me is giving me good things. It's telling me this company is learning how to make its product at a cheaper rate, which or it's able to have a margin better than it had 2 years ago. So once this revenue starts kicking up, this company will definitely be good, and I'm actually liking it right now for that reason alone. So here we're going to take a look at red flags from Lazy FA. Pretty great stuff if you guys haven't taken a look at revenue versus cost. We can see right that revenue, like mentioned before, revenue is the gap between revenue and cost of revenue is approaching, and that's why we have a declining gross profit. Next, we'll take a look at their gross margins and their profit margins. So their gross margin seems to be a little bit uptick compared to previous quarters, but it's still not too far away from its average. So its average seems to be somewhere around low 60%. Right now it's at 63.1%, higher than last year, the year before, and few years, almost I think since gross margin right now it is higher than 2011. So that's a lot of years that this company has been increasing its gross margin. And here we have a very nice profit margin. Today is sitting at 20%. That's been its all-time high for the past six years, maybe a little more. But that's great to see. We're seeing that increase in profit margins. Obviously, profit margins last year was pretty low, but that's because of that tax expense. This year, profit margin is it's higher than the previous years, and that's why we're seeing that net income so close to last to 2 years ago, even though revenue has decreased. So I'm really liking profit margin. To me, it's just telling me this company is being smart with how they are making their products, right? If they're able to make more same amount of money with selling less products, their profit margins are increasing. It means their expenses are decreasing in some form. And if this company starts picking up its revenue is going to start, its net income is going to be a lot higher. So here we have a few red flags on Lazy FA. The first red flag is just telling us on average cost of revenue is increasing at a faster pace than revenue itself. And I'm pretty sure it's this year in 2011 which is throwing us this flag. But to me, like I've mentioned, it does not look that bad in my mind. So this flag, I'm not gonna keep mind to it. Next, we have a top to the line divergence alert, and it's just telling us net income growth in the past year compared to sequential. So obviously, since last year, the net income growth was pretty low. The net income was pretty low last year due to that huge tax expense. This year is showing about 400% growth in net income compared to last year. But like mentioned, it was due to that tax expense. So we would expect to see that huge net income growth. But in reality, we know it's not based on anything crazy. It's just that tax expense that made this a little crazy for last year. So again, this is a great red flag if we didn't have that tax expense last year. So here, now we'll take a look at some quick charts of some stuff we didn't look. I just want to see how their operating expenses are changing. We can see, right, a huge decline in operating expenses, SGA, sales, general and administrative expenses, and we can see interest expense is pretty on par. So I'm liking, even though revenue is decreasing, I'm still liking how this operating expense and SGA expenses are dropping down. So hopefully it means this company is being smarter with their money. There's nothing insane with tax expense. It's pretty on par with the other years, except this last year's outlier where this company had to pay a lot more in taxes, but that's most likely due to the tax changes here in the United States. All right, so right now I'm really liking Coca-Cola. Next, we'll take a look at their balance sheet. We'll take a look at total assets, liabilities, debt, cash, and cash equivalents. So here in total assets, we can see total assets decreasing, but it's not decreasing at a huge pace. Last year's was 87.9. This year was 83.2 billion. So it is about 4 billion, it's about 5%, a little less than 5% of assets decrease. But if we're looking at liabilities on the same year, it probably has a higher decrease percentage. So this year they have liability of 64.1 billion. Last year 68.9, almost 69. So about a 5 billion delta. Here we can see their total debt is being paid off. I do like to see that. So total debt last year hit the peak at $47.7 billion. Right now is $43.5 billion, and that's less than 2 years than 2016, 2017, and it's a little bit higher than 2016, 2015, 2017, and it's pretty much on par with where that level was in 2014, a few $billion more, but I'm definitely liking that huge decrease in total debt. Here, receivables, they have decreased their receivables, but we noticed, right, revenue has been decreasing. So that means their revenue, since the revenues are increasing, their accounts receivables percentage by revenue is also going to be decreasing. So this doesn't really freak me out at all. Payables, their payables seem to be decreasing, but it seems they have some form of steady flat rate or something amount of money they're paying to its providers of suppliers. And we can see since 2010 this has pretty much been on average of where it's supposed to be at 8.93 billion, and that's okay with me, right? It's telling me this company, no matter how much it sells, is still gonna pay about the same amount in payables, and it's something we should probably see similar levels next year. Cash and cash equivalents. I'm liking how this company has a decent amount of cash and cash equivalents. It has almost $11 billion of cash, and remember we said 83 billion is total assets. So this is cash and cash equivalents, which are assets that could be liquidized pretty quickly, is a high percentage of its total assets, and that's definitely a good thing in my books. Next, we'll take a look at red flags from Lazy FA. Again, red flags is just another way to see what we just saw. Here we can see our total assets and total liabilities together. We can see, unfortunately, that gap is decreasing, so that means our shareholder equity has been taking a dump, and we can see here it's been taking a dump. But last year to this year's is pretty close to being the same levels. Last year was 17.07 billion. This year was 16.98 billion. So only a decrease of 0.09 billion dollars in shareholder equity. And to me, that's not good. I'm not bad. I am a little thrown off that the shareholder equity is decreasing. It has such a close gap, but it's good to see we had a flat line for the past 2 years. So hopefully next year we see another flat or an increase in shareholder equity. Here we have assets versus liability growth. There's nothing really crazy here happening right now. This year assets shrunk by about 5%, 5.3%, and liability shrunk by 6.9%. So as long as we keep liability growth shrinking at a faster rate than assets, that shareholder equity is going to go higher. Now we're going to take a look at the asset distribution and liability distribution just to see what this company is truly worth. So we can see it's definitely pretty spread out here. We have 15% of its assets based on cash and cash equivalents. Another 7% are on current investments. So that's good. That means 21, maybe 22% of his assets are based on assets that can be liquidized pretty quickly and be turned into monetary value pretty quickly. Then we have 28% in non-current investments. So here we can see we have over 50%. Am I right? Yeah, over 50% of the assets are based on some form of investment or cash monetary value. So that to me it's definitely really good. It means this company is managing its money properly, and it's not just buying equipment and just building up inventory to build up its assets. So this is definitely a huge portion, and again, this is looking really good. 11% is property and plants, and we can see property and plants have been decreasing over time. The things that have been increasing in the past few years have been non-current investments. What else has been increasing? But we've seen a decrease in intangibles assets, and that's actually a great thing. I hate to see a company have so much worth in intangible assets, even though they could be worth all that money. To me, it's just like a fake asset to me, that the value of the assets are fake. It could probably be worth a lot more or a lot less, and for that reason I don't like seeing a company with such high intangibles. And I'm happy to see that this company has been dropping it. In 2000 and what year is this? 2000, at the end of 2013, intangibles were 27 billion, which were 33% of the assets. Now it's at 17 billions. So a huge decrease in intangibles, which is definitely a great thing to see. Cash and cash equivalents have has had its up and downs, but nothing crazy. All the other assets are pretty on par. The only other thing I like is just that non-current investment has been going up at a steady pace, while that intangible has been going down. Next, we'll take a look at the liability distribution. We can see a huge portion is non-current debt. Non-current debt is about $25.36 billion at 46%. So that's almost half of the liability is non-current debt. But we can see compared to last year, this company paid off a huge portion. Last year was 31 and was 52%. This year is 25 and is 46%. So that's definitely a great thing. Current assets, it's pretty high right now at 33.2%, but last year was, and it's at 18 billion. Last year was 16.5 billion, and the year before that was 16.02 billion. So just an increase of $2 billion in current debt is definitely gonna affect the company's cash flow next year. But it's such a compared to the company, the value increase is not that much that I'm not it's not something I'm worried about. All the other liabilities are pretty on par. So about 70 about 80% actually 80% of the liabilities are non-current debt and current debt. So we're gonna definitely take a huge portion down this year when it pays off all its current debt. So that's definitely a great thing to see. So red flags, the only red flag we have today in the balance sheet is that at, on average, liability growth is growing at a faster rate than assets. And this is most likely due to this 2010 year where liabilities grew almost 80%, where assets only grew 50%. So it's just telling us, hey, take a quick look. But if we look at the previous years, even though liability does grow at a faster rate, it is nothing to really be scared of, just because of the monetary value at the moment is not really, assets is still such a huge portion of the balance sheet. So here we're gonna, usually I take a look at the cash flow statement, but today I'm not going to do that. I'm gonna take a look at their I'm putting some of the important stuff I watched in the cash flow here in this chart. And the first thing we see is net cash flow from operations. And again, this is really good. Last year, this company had a lot more revenue, and even though net cash flow is higher this year, they also did have a lot more expenses, but it's definitely good. Even though 2 years ago, this company had more net cash flow. Next, we have current debt. We can see its current debt is increasing payment wise, which would also affect our net cash flow from financing, since it is high debt. So this upcoming year we have a 18 billion current debt. So we would definitely see probably a much higher value on net cash flow, unless it's taking off more loans. But if not, then this company is definitely going to have a lower, more negative, if one can say that, more negative net cash flow. So it'll be further down. But because of its cash flow from operations, I'm pretty sure this company will still be in the green in there. So again, nothing really to freak me out at the moment. And then this is nothing. Then we'll take a look at these new aspects that Lazy FA has added, manipulation. And we're only going to take a look at a few stuff. Here we can see, like always, we've seen revenue decreasing. So let's just talk percentage wise. Period to period, this company has had a decrease of revenue growth. This year compared to last year was a 10% decrease in revenue growth, where the year before that was a negative 15% decrease. And so it's definitely, we're not as bad as last year, but our revenue overall is declining. Quarterly to quarter sequential, we're having, I want to do period to period. So same quarter last year, revenue growth has decreased 6% to this year. This year has decreased 6% in revenue growth compared to last year. Account receivables year to year change, nothing really crazy. Obviously, we're going to see a change of accounts receivable just because we have a revenue decrease. And this quarter compared to last year's same quarter, it's about 7% and it's close to that 6% which we saw. So nothing outrageous there. This is one thing I like seeing. This is one of their new features, the revenue capacity. So here we have trailing 12 months revenue. So it's the revenue of the last 12 months opposed to quarter. And here we can see revenue capacity. So revenue capacity is the the TTM revenue, so the trailing 12-month revenue divided by the gross property, plants, and equipment assets for the period. So this is the trailing 12-month revenue divided by its total property, plants, and equipment. So what is this telling us? So this is going to give us a ratio, and it's going to tell us that, hey, this company is actually, even though it's collecting less revenue, it has the same amount of assets and property and is still maintaining this strong ratio. So we would want to have a really high ratio. The increase in ratio in this ratio means that this property is making more revenue with the same amount of equipment. So that's definitely a great thing to see. And we can see here, right? We can definitely see that overall this company has an uptrend, even though there are downtrends going on. Overall, this company has increased its revenue capacity. So it's producing a lot more revenue with a lot less equipment. And that's definitely a great thing to see. And again, it's another thing of that profit margin. That with the profit margin increase is definitely going to help out this company in the long run, right? Next, we have account receivables percentage of sales. So it's just telling us how much percent of the revenue is account receivables, and it's pretty balanced to where it's normally is. So it's nothing I will continue looking at. It's pretty on average. There's no outliers. Same with day sales of outstanding. That's how many days it takes before the company collects its money, and again, it's pretty average. The only other one I really want to take a look at is this company has no unearned revenue or deferred revenues. So that's definitely, its booking to revenue ratio is 1. And that's definitely a great thing. Next, we'll take a look at manipulation on expenses. The manipulation, right, is just lazy FA doing some form of calculations and it's telling us, hey, it's here gives us a procedures of what to follow, so we can know if we can take a look at something else. So questionable assets that are in the others column and don't really give us are questionable. But again, this has increased over time, but it's pretty on par where it's supposed to be in that increase. We can see current questionable assets versus total assets percentage, and it has that increase, but it's nothing dramatic, so it's nothing I'm gonna freak out about. Same with non-current, right? It's just be above. The current questionable assets are about 5%, 5% compared to the total assets, which is good. Being below that 10% is something that wouldn't really freak me out. And same with non-current. Non-current doesn't change as fast, so it's a better look at things. And we can see here that it's between that 5% range. So again, nothing has changed in there. And the total assets, again, it's been pretty on par with its averages. It has this window where it goes up and down. So that's again, nothing to really freak me out about. What else we want to take a look at here? We have net income minus operation cash flow. So this is just right, like I mentioned, net income minus cash flow from operations, and it's here great. We would like to see a negative thing. It means this company right here, it tells us negative value in this cap indicate that cash from operations was greater than net income, and that's a sign of positive earning quality. Positive values indicate a sign of questionable earning quality. So we can see here, it's right now we're on the negative. This company is making better operating cash flow than net income. So that's definitely a great thing. And those are the few things I wanted to look at. And there's one more thing we'll take a look at before I make my decision. It's just their report. So here, right, we saw net revenue decline 6% for the quarter compared to last fourth quarter, and 10% for the full year. Again, we saw that right here they're again telling us about the net revenue. I highlighted just because it's important to know net revenue declined 6% to 7.1 billion for the quarter and declined 10% to 31.9 billion. But we did see this. Their margins increased. We definitely saw margin increase. This company is also saying that they're increasing their market share. Market share, gain value share in total non-alcoholic ready-to-drink beverages has increased. The cash flow from operations for the full year has increased up 6% from last year. And full year cash flow, one I don't really take a look at, full year free cash can easily be manipulated with all the other cash flow statements. That's why for me, the favorite one to look at is cash flow from operations. Share purchase, this company is buying back its stock. It has 1.9 full year purchase of stock for treasury. And it's repurchased a total of 442. So I compared to the other stocks I've been looking at, this company is not buying as heavy as the other stocks. There have been some change in key leadership, but to me that's not that important at the moment. They are growing their portfolio. The company has helped launch approximately 500 products this year alone. And this is actually pretty, I highlight this because it might be negative in the expenses wise, but they said in early 2018 the company introduced its World Without Waste initiative, which includes a goal to collect and recycle one bottle of can for each one the company sells by 2030. So this might actually cost the company some money, but I think we live in such a world that something like this will impact customers to buy more of their products opposed to other products, just because a lot of people are environmentally conscious at the moment, right? So it's even though it's definitely great for the environment, it is definitely a great brand awareness point. So I definitely want to mention that. Let's see what other points I have highlighted. So for next year, they have an approximately 4% growth in organic revenue. They have cash flow from operations at least 8 billion, at least 8 billion. So let's take a look at real quick of what their cash flow from operation is this year. So 70. Okay, so that's definitely a great thing to see. They are expecting net cash flow from operations to be at least 8 billion. But that was, let's take a, okay, yeah, I was looking at the annual. I was just making sure I wasn't looking at quarterly. They are saying earnings per share to growth by about 1%. Not much, but a decrease or decrease. So it's pretty much going to be pretty neutral. What else do we have here? Then here, just a quick look at their overall, at the overall revenue compared to its demographics. So here in Europe and Asia, these are the past 3 months. So net revenue decreased 12%. In Latin America, 2%. In Latin America, it decreased 12%. In North America, it increased 7%. In Asia Pacific, it increased 1%. But here's the more important things, and this is what I find pretty scary in the past quarter is revenue. And this is comparing to the same quarter of last year. Um, income, total income after tax, before taxes, total income before taxes for Europe decreased about 45%. For Latin America, decreased 14%. For North America, increased 6%, decreased 6%, and for Asia Pacific, it increased by 19%. And here it's actually a huge thing. Bottle investments, their bottle investments increased by 88%. They had a huge loss of about 618 million last year. Same quarter this year was 75, a loss of 75 million. So total at the most important thing is total. They had a decrease of 16% income compared to same year last year. Now, if we take a look at it in the year's end, it's a whole different change. Net income increased by 24%, and here we can see Europe has, opposed to being a decrease last quarter, they definitely had a huge decrease. But overall, they've increased their sales in Europe
and Asia by 4%. In Latin America, it's pretty flat. In North America, they increased it by 9%. In Asia, they decreased it. It's pretty flat in the Asia Pacific. And then consolidated total, it was the 10% decrease in revenue. And here, net income somehow, not net income, income before operating taxes increased by 24%. So that's definitely a good thing to see. So just a quick review before I give my decision. Revenue decreasing, cost of revenue is decreasing as well. Our gross profit is shrinking, but we saw that the our earnings before income taxes is at a high, it's still high, even though it's comparable to 2 years ago when revenue was up 10 when revenue was up by 10 billion, and that's almost 30% of where it's at now, a 30% increase. So that's pretty impressive that earnings before income taxes are so close to those values. And here net income again also the same thing. So to me the income statement is definitely giving me a buy just for that, right? We have that positive profit margins. So the moment this company starts collecting more revenue, this company is going to have one of its best net incomes. We'll take a look at total assets versus liabilities. One thing I do like, I'm not liking how the shareholder equity is decreasing, but it is nice to know it has bottomed out. That's great to see. This company is paying off a lot of its value, a lot of its debt and current debt, and we saw the huge portion of the assets, over 50% of the assets, are some form of monetary value: current investment, non-current investment, and cash equivalents. And now that I'm looking at it, based on these three, on just those three assets, this company can pay off its non-current debt and current debt together. So that's definitely a great thing to see, in my opinion. There's no red flags here that are really freaking me out. And then from here, we know from their quarter report, from their report we just read, that even though there has been a decrease in the quarter in certain regions, overall for the year they did increase or flatlined on revenue increase in those regions. It also told us that operation cash flow is going to be around 8 billion, a lot higher than this year and a lot higher than the previous. When was the last time? So it'll be pretty on par to 2016. So for those reasons, I am going to give Coca-Cola a buy. I'm happy I did this show today. I'm definitely going to take a look at Coca-Cola. It was a company I wasn't really keeping my eye on because I thought there wasn't much growth potential. But once I saw that profit margin and how it's able to collect that earnings before income taxes and that net income, keep it to get such a close rate compared to its revenue decrease. So once this company has higher revenues, we would definitely see a higher net income. And for me, Coca-Cola is definitely a buy. So I'm gonna definitely look into buying some Coca-Cola shares. So I hope you guys enjoyed today's episode. Like I mentioned, Lazy FA makes it so easy to look at all the information, which makes these episodes go pretty fast. I'm curious, would you buy or pass on Coca-Cola based on the information we just saw? Also, don't forget to subscribe to get updates on new videos, which I try to post every other day. If you guys have a company you guys want me to take a look at, make sure to post it in the comments and I'll take a look at them next. Have a good night, guys, and see you next time.